Hello and welcome. This is the Insurance Pro Blog Podcast. This is episode 449. I am Brandon Roberts.
And I am Brantley Whitley.
And you are listening to the internet's favorite podcast about life insurance.
Mm-hmm. That's right. We're actually going to talk about life insurance today, too.
We're going to talk about life insurance. We're going to talk about the big one.
The big one.
The hot life insurance topic that has been...
Hey, I'm gonna pull one deep. I'm going to pull one from way back.
Oh, okay.
The Winston Cup of life insurance. That's probably going to get us in some trademark or copyright trouble.
No more trouble than it could get us into with T. Rowe Price.
Yeah. There you go.
So the topic du jour that's on the tops of everybody's minds. I know.
Well, at least 10 or 12 people anyway.
Yep. Hey, that's twice the number of people who listen to this podcast. So there you go.
Yeah.
We're going to double our listenership.
There you go.
If you haven't heard, a certain race car driver has filed a lawsuit against a certain insurance company that's well known for whales and indexed universal life insurance. Kind of in that order.
I would say they're well known for whales. They're infamously known for indexed universal life insurance.
Yeah.
Mm-hmm.
By popular demand, we're going to talk about the Kyle Busch thing.
Yeah. We weren't going to talk about it because everybody else was talking about it. And we're like, I'm not sure what else needs to be said about it, but people asked us to talk about it. So we're going to talk about it.
They did.
I'm going to toot our own horn here for a second.
Toot away.
Say that you and I, before we knew any of the details, because this, we learned about this a couple weeks ago.
Yep.
Right after the court case was filed or whatever. I think that was on the 14th of October or something like that. It was a couple weeks ago. And we automatically knew what the problem was. Like before you and I even looked at anything. We're like, I bet you what happened was, and you'll have to stay tuned to the last 5 minutes to find out what actually happened. But you and I, we could read between the lines. It's almost like we've seen this before.
Well, yes. I was going to say eventually. You're giving me too much credit because I thought, one more premium finance case gone wrong. And that's not here.
That's not even what happened.
No, didn't happen this time. All the premium finance people can breathe a sigh of relief.
Turns out you can screw something up royally without using premium finance as well. So,
This is true. So the facts as we understand them from the complaint that was filed, from the media reporting, from people who dig deep into the details and get certain information that the rest of us didn't have it at the ready. The Busch family, Kyle and his wife, purchased indexed universal life insurance policies from Pac Life.
Mm-hmm.
They bought them allegedly.
The first two were 2018.
Yep. Allegedly under the impression that the agent they were working with, a Rodney Smith from Arizona, was a wealth advisor who aligned himself with Pac Life specifically because of their position in the market, their integrity, their ability to provide, I believe the complaint says something to the effect of proprietary products that are basically designed to build tax-free wealth for...
tax-free retirement plan.
Okay, tax-free retirement plans.
Yeah.
For individuals on the level of economic achievement that the Bushes were conceivably at when they started having this conversation.
Yes.
Elite clients. That's the word that I circled in the complaint.
Mm-hmm.
It's always good to scroll and talk, and then those things pop up for you. It turns out things didn't go the way they were supposed to go.
Yeah.
And there's
so many oddities. It's like kind of hard to even know where to start. There's just so many weird things that we immediately looked at and were like, well, that's an odd setup. If your stated goal was, quote unquote tax-free retirement plans.
Mm-hmm.
That's an odd structure to achieve said stated goal.
Yeah, it is. But before we get into some of the more specifics about the policies, what happened there, and the fact that this is totally being used right now by those who don't like cash value life insurance.
Oh, it's a cudgel. This is the perfect cudgel.
Yes, this is like, see.
We told you it was a scam.
Yep. But we're going to get there. But before we get there, I want to talk about some of the elements behind the positioning here. Like what led the Bushes down the road of working with this individual and buying these policies, and something that's going on, if we read between the lines, in terms of what the plaintiff's attorneys are trying to accomplish here, that is interesting and perhaps a slightly frightening for insurance agents in general.
Yeah,
because there's a decent amount of language in the complaint that speaks to the fiduciary duty that was owed to the Bushes from the agent and from Pac Life, which on its face, if you're a layperson, those are just words. But to people like you and I, we look at that and go, wait a minute. Life insurance agents don't have a fiduciary duty.
Right.
Now,
that's a very specific legal definition.
Yep.
That's the way we see it because of we've been around for a minute or two.
So for those who really care about those details, generally there are two kind of standards of care, if you will. So you have the suitability standard. So is this suitable? Which is to say, look, it ticks the box of the primary objective. Is it the absolute best one out there possible? That's not really a primary concern here. All we're really concerned about is that it actually does the things that these people are seeking to accomplish.
Right.
Fiduciary duty, on the other hand, says not only does it do that, but this is, best to my knowledge, the absolute best way to do it. Very different. Some might consider subtle, but very different standard to be held up against.
Well, and I believe this is my interpretation. The subtext of that is that did the advisor, did the agent in this case, act in his own best interest or the best interest of his client? Because that's the fiduciary standard, if you want to put it into common speak, is are you acting in the best interest of your client? Because that's what you're supposed to be doing as a fiduciary. Now, legally speaking, an insurance agent is not a fiduciary.
No.
Unless they have other licensure that makes them a fiduciary, but that's a separate discussion for a separate day.
But the claim or the position that the plaintiff's attorneys are taking here is the agent, and by extension Pac Life, based on how involved in the sale they got, presented himself as an advisor in the fiduciary capacity.
Right.
And because he
not necessarily explicitly, but through implication.
Because he chose to market himself and his services to the Bushes in that fashion, he now has a fiduciary duty because they would expect him to have a fiduciary duty. And therefore, they are going to litigate this case based on his violation of upholding that standard.
Right.
Which is an interesting position to take.
Yes.
And one might argue, if they can successfully litigate it that way, may set a precedent for everybody moving forward. That's not to say that all of a sudden every insurance agent becomes a fiduciary. But every insurance agent who does not explicitly disclaim that role or that duty would theoretically subject themselves to that responsibility.
Yeah. We'll just have to see where that goes. But it is an interesting component.
So,
but not as interesting as all the other details. In my opinion.
Well,
it's just something we noticed.
Yeah.
because it was like, that's different.
So the question that comes up, obviously for us especially, but I would think for most people who look at this and go, well, that's interesting, is what led to the disappointment?
Yeah.
What led to what led?
That's such a polite way to put it. The disappointment. We're just really disappointed in you.
Hey. Were you never the recipient of "We're not mad, we're just disappointed"? That's supposed to be the one that gets you right in the.
But it typically wasn't after I lost my dad $8.5 million. So I feel like there would be stronger words used.
Touche.
Some threats may be involved. I don't know.
So we look at this and we go, what went wrong? And the complaint itself doesn't have a lot of detail on that front.
Yeah.
There are casual references made. There are some things that are specific to policy design that the complaint does mention.
Yeah.
Things like the lack of Pac Life's term blending feature, which is super unique to Pac Life.
Mm-hmm.
The way the policy was set up in terms of
time out. Not that term blending is unique to Pac Life, but the way it's implemented at Pac Life.
Yes. Yep.
Okay. Sorry. Just to clarify that.
The way the death benefit option was set up and used, which again is kind of unique here, because there's a design element that was implemented that by all accounts is pretty much the right way by the book, but in this case was the wrong choice given the circumstances.
Mm-hmm.
So the complaint itself definitely touches on some of those things, but we have to give credit to Bobby Samuelson at the Life, what is it called?
Product review.
There we go. Life product review. Sorry, Bobby. For digging much more deeply into this and having the actual policy details to outline what exactly went wrong.
Right.
And which
confirmed our suspicions. We didn't know the details, but we.
Yep. Yes. The unsurprising surprise is really, really horrible product design execution.
Yep.
That leads us in the direction of assuming somebody knew how to pull the cords to make money for somebody when it came to this sale.
Uh-huh.
So
somebody wanted their own race car.
And the gas to
yeah, that's right.
So there are a number of things, but the one thing that I want to address that to me is almost a non-starter for somebody who might come to us and say, hey, I want to buy index universal life insurance to accumulate cash and have retirement income. Mm-hmm. And look, let me also admit from the beginning that I highly, highly doubt the Busch family went to this guy and said, hey, we've been reading up on that index universal life insurance. And I'm going to guess that the agent probably was the person who first put it on the table for them.
I believe the complaint expresses that.
Yep.
Yeah.
So, okay, fine. That situation's a little different from what you and I typically deal with. But if somebody were to come to us and say, hey, I've been looking at life insurance. I'd like to look at it for me for the sake of building wealth or a future retirement income stream. But I'm a race car driver. And knowing insurance like I do, there are certain things that you could do either professionally or in your spare time that would make you a less favorable candidate for this kind of application of life insurance because it's going to come with some additional expense.
Right.
And we find here from the details that the policy issued to Kyle Busch came with a flat extra.
Right.
So
you want to explain what that is?
Yeah, let's address flat extras. So in the world of life insurance underwriting, when an applicant has various features or attributes that are less favorable from the standpoint of they're not going to die, there are a number of things underwriters might do to to account for that risk.
Right.
Most people know about table ratings. Those have to do with health issues.
Mm-hmm.
Flat extras are a way that we deal with things that are not health related. So these are things like auto racing. They're things like mountain climbing, deep sea diving, skydiving, things of that nature that do present a potentially higher risk of death, largely by accident, or basically entirely by accident, for the individual. And in this particular case, the flat extra assessed on Kyle's policy was $4.92 per $1,000.
Right.
So to put that into context, the reporting as we got it from Bobby Samuelson was that there's a policy that was issued. This was kind of round 2 for $44.5 million of death benefit.
Right.
So $44.5 million death benefit at inception, ignoring any cash value to reduce net amount at risk, would come with a nearly $219,000 of additional expense from the flat extra alone.
Right. Which would throw a wet towel on any sort of internal rate of return on cash.
Yeah.
Perhaps.
Yep. Oh, and let me clarify, that's that $219,000 per year.
Right.
Not entirely.
I believe it was for 20 years, right? That's the flat extra.
I don't know.
I think that's what it.
Okay. Could be. Yeah, actually I see it right here for 20 years. Yeah. So that flat extra.
And I'm sure that was just assuming in 20 years he won't be doing this anymore. So.
Right. That flat extra, the effect, the total cost of it, in theory, should go down in terms of gross expense. Because again, if this is being done with a finite number of premiums, as we understand it in this case, so the plan was to pay $1.5 million for like a 5-year period. So at some point, the policy should have a level death benefit. If that's happening, cash value is growing, death benefit's not, which means the net amount of risk is going down.
Right.
Which means even though the flat extra is still $4.92 per $1,000 of death benefit outstanding, net amount of risk, the net amount of risk goes down. So the actual cost isn't always $219,000. It could go down. But when it starts that high, that, as you put so eloquently, throws a wet towel on the excitement that we can get, because that's $219,000 that has to leave the policy as expenses that you and I could apply for the same policy and not have to contend with.
Right. Well, and like in his wife's case, didn't have to contend with that.
Mm-hmm.
So,
yeah. So that is a huge impediment
to a tax-free retirement plan.
Yeah.
Yeah. That's it's probably gonna.
It's just a big impediment.
Yeah.
Now we also gleaned from the reporting from Bobby that the policy that was originally sold was designed, and it looks like the second 2 policies that were issued afterwards, they matched basically the planned premium to target premium.
Right.
Which means there was a lot more death benefit than there needed to be in place.
Correct.
And in general, that's a bad policy to have when it comes to life insurance product design.
Yep.
Because it's not going to be the most efficient life insurance policy for cash accumulation purposes. There's too much death benefit, which is cost prohibitive to cash value growth.
Right.
It is especially a bad idea when we're contending with a flat extra.
Yep. And even more so when you're only planning to make, I believe it was 5 premium payments.
Yeah. Yep.
So in a short pay scenario like that on an IUL policy, you'd want to have you would want the net amount at risk to be severely declining over that 5-year period in that example, such that the internal policy expenses were decreasing rapidly, so that the policy may have a chance of better supporting itself. You know, one of the other claims that was made I just feel like this is a time to bring this up.
Yep.
According to the complaint, was that the agent repeatedly referred to this as fully funded.
Yeah.
There's no such thing as a fully funded IUL policy.
No. Nope. Fully funded it's.
I mean, it may be fully funded to the extent that you funded it as much as you care to fund it, but there's no guarantee.
Technically speaking, it's not the same as, but many people would consider it synonymous with paid up.
Right. But it's not paid up.
No. There are no paid up universal life policies. But
right.
Technically, there are a couple products out there that do have the ability to achieve some sort of paid up status by design with the company. But in general, when you're buying cash focused indexed universal life insurance, there is not going to be a paid up status you can achieve. There are things that you can do with universal life insurance that will kind of mimic some of the things that would happen with a whole life policy to create a pretty high probability of no premiums ever being needed ever again.
Right.
But that would not include having your target premium equal to the premium being paid, though. No.
Because that's just going to buy way too much. Now we're getting off in the weeds.
That's okay.
Sorry, but
that's always a very careful conversation that we have on the subject of whole life insurance paid up contractually guaranteed, universal life insurance not paid up contractually guaranteed. Again, mimicking some of the things that are going on with the whole life policy to severely limit the chances that you'd ever need to put money in there, but they are not the same thing, and you should not make that mistake.
Right.
Just for some numerical reference here, I did run some hypotheticals, not at Pac Life, just with a random indexed universal life insurance policy, to look at the difference in cost on the flat extra part, because I can't convey enough to the lay people how much of a non-starter that part is to me.
Yeah.
Like, we don't even get into the discussion about adequate death benefit when we have a flat extra on the table. It's just too much to me to say, yeah, we should move forward with that.
Right.
So looking at a $1.5 million planned premium, not doing what the agent did, but solving for the minimum possible death benefit we could have to qualify as life insurance. When we have the flat extra on the policy, and just looking at the total of expenses over a 10-year period, and I did in this case assume that the premium was just going to be paid for 5 years. The difference in charges, total charges against the policy, actually I shouldn't say total charges because I ignored premium charge and the typical policy fee for this. I just added up the cost of insurance and the per 1,000 charges. Difference in charges assessed against the two policies, flat extra, no flat extra, is over $660,000 over a 10-year period.
Yep.
That's a
big difference.
Amount of money that has to be paid.
Yeah.
It changes the cash value accumulated by year 10 by about $1 million.
Right. Yep.
Look, I like life insurance, but when you're contending with that sort of impediment, it's my opinion that there are probably other options that are close to life insurance that start to elevate because of that holding it back.
Right.
So one of the dilemmas that exists with Pac Life that is going away in many respects, but did exist for a long, long time, was the way that they approached designing death benefit with what was just universal life insurance and then a term rider.
Right.
And I know this causes confusion for people who have listened to us for a long time because we've talked a lot about using term riders on whole life insurance to build better policies, but we rarely say anything about universal life insurance. And the reason we rarely say anything about universal life insurance is because for the most part, Pac Life being the one exception, it doesn't work.
You don't need it.
No.
In an IUL policy.
You don't.
Pac Life is definitely as far as I know, the
exception to the rule.
The exception on that one.
Mm-hmm.
Yeah.
Pac Life had for a very long time this weird element of having an astronomically high commissionable rate paid on just regular indexed universal life insurance death benefit.
Right.
But you had the ability to dial that down by blending that death benefit with term life insurance death benefit to get the same net death benefit you needed, but you just got paid less.
Right.
It was always a very bizarre design element.
Not to mention all sorts of other non-guaranteed elements.
Which oddly
that made their illustrations.
Yep.
What's a good word to put it? Fantastical. I mean, I don't think we're alone. I think a lot of people in the industry that you and I have talked to were just always uncomfortable showing them, because it was like, I don't know that what I'm looking at is accurate in any sort of way.
Mhm.
It's how much fantasy is baked into this illustration versus reality.
Mhm.
And given the fact that we have an infinite number of choices as independent agents, you just go, I'm going to stay away from that.
Yeah. We have, I didn't think to go back and try to find it before now. We have a podcast. It was recorded 8-ish years ago.
Mm-hmm.
That dove into Pack Life somewhat specifically on the subject of various multiplier bonuses.
Yep.
Noting that we can't be doing this. Like,
right.
This is a bad idea to create, especially non-guaranteed bonuses. And yes, Pack Life will say, but the bonus does have a guaranteed element to it. Yes, it does. But functionally, the way it works is not guaranteed in terms of what comes together as the attractive part.
The way they illustrated it.
Right. And the way that they would illustrate this thing was, you would assume, because you went in and you opened up the software and you plugged in a number like 5.5 as the index credit. But because of the bonus that was being applied, it turned into like a 14% effective index credit every single year.
Right.
And it way overstated what the product was likely going to do. And look, we have seen indexed universal life insurance policies perform way in excess of the assumed interest rates that we used to project values.
Sure.
That's great. We are not going to now go back and say, well, we look at these policies and on average we've done 8.5% or 9%. So we're going to assume that. One, we can't, but two, we wouldn't do it anyway.
Right.
We're going to stay with the numbers that we've always used, because things aren't always going to work out as well necessarily.
Sure.
Yep. We do have to ground this in some basis of reasonableness. And the policy that the Bushes bought, according to the reverse engineering that Bobby Samuelson did, suggested like an internal rate of return illustrated of like over 6%.
Right.
Despite the fact that the index credit assumed was 5 3/4. That math doesn't math unless the bonus comes into play. And
I would like that math if it went in my favor, but I don't know what universe that's going to go in my favor.
Right. So there's other things here, like the fact that the death benefit didn't get switched like it was supposed to be. A lot of the cash sat in the fixed account for a couple of years.
Yeah, that was an odd.
When it shouldn't have.
Like, why?
These are all bad things that, you and I have had, as you kind of hinted at, a very hands-off opinion about Pack Life's IUL product.
Yeah.
Like, we don't have a relationship with Pack Life.
Right.
We have access. We have access to the product as far as looking at it and illustrating it.
Yeah.
But we don't sell it. And we don't advocate for it, because long before anything like this comes out, Pack Life has just carried a reputation for having a wonky product with some very strange, you got to be very careful about what you assume, kind of elements in our eyes. Look, some people bought it. Some people loved it. I'm not saying the product can't work. I'm just saying that there's a lot of things about it that have always made us a little uncomfortable when it comes to, are we overstating what this thing is realistically capable of accomplishing?
Right.
And there's way too much that we have looked at out there that causes us to take a step back on that. But none of that is really at play here.
No, because though, well, I think we can both look at this case and go, there are ways that these policies could have been designed
Mhm.
that I'm not saying they would have had the best possible outcome that they could have had, considering the universe of IUL products that were available.
Hmm.
But they could have had a much more favorable outcome than they did.
Mhm.
Even within the Pac Life world. That's what I'm getting at.
Yeah.
Like, these particular policies could have been designed in a way that would have benefited the Bushes. And I mean, based on the series of events as I understand them, would probably never have caused them to look into it to see if they could have done something better.
Yeah.
But the fact that they paid all the premiums they were supposedly going to have to pay, and then they get a premium notice a couple of years later.
Yeah.
And then the policy, I believe they lapsed, right?
I don't know.
Yeah.
There's
I
a
believe
reference.
so.
There's a reference somewhere in the reporting from Samuelson about that, but I don't know.
Yeah.
But yes, like this could have been done, even with the flat extra that I keep harping on, that would have put them in a position where I don't think there'd be any reason to be nervous or upset or questioning what happened.
Right.
Because even with that marching against them, they could have come together in a way that would have produced some pretty significant interest payments. And you think about 2018 to now, there are a number of products that existed that just using their standard S&P 500 one-year point-to-point account would have produced pretty consistent double-digit interest payments.
Right.
And if it were correctly designed with the lowest possible death benefit for the planned premium, that would have produced a pretty significant amount of cash value by now.
Yeah.
There wouldn't be an issue with the policy having too much in terms of expenses.
Right.
There
was the other weird inconsistency that I point. This is kind of out of left field, but it is an odd to represent something as a tax-free retirement plan.
Mm-hmm.
And then to the original two policies on husband and wife were both owned by an irrevocable trust.
Yep.
Which I'm not saying there's anything wrong with having a life insurance policy and a irrevocable trust. That's an estate planning play.
Yep.
Typically, and not a place you would have a tax-free retirement because of the logistics of then getting the money out of the trust later and beneficiaries having to be involved. And
it becomes monstrously harder to take distributions from an IUL.
Yeah.
Than if you just own the policies.
Right.
And
so there was a mixing of metaphors here, so to speak.
There's really not a clear path to, look, you're a successful individual, you've got a high net worth, you should use life insurance for tax-free retirement, and you should also put it in an IUL to pull double duty on the idea that it could avoid a certain amount of includable gross estate. Those two things, I'm not saying it's an absolute impossible scenario, but it doesn't make a lot of sense.
Right.
And so that was a weird maneuver.
Yeah. And the look, the bottom line is, if you're going to design an IUL policy for maximum cash value growth, which would be the what you would be doing, that's sort of what's going on behind the scenes. If you're targeting using the income from a life insurance policy as a supplemental, tax-free retirement income source, then it's got to be minimum non-MEC death benefit.
Mm-hmm.
You say, okay, you got $1.5 million. What's the minimum death benefit?
Yep.
That we can solve for.
Yep.
And then I'm not saying, because in his case with the flat extra, it still wouldn't have performed great. but I don't think it would have run into the problems that it ran into with needing additional premiums.
Right.
Not that quickly.
There would be some adjustment on the actual death benefit needed because of the flat extra. So that would actually give him less death benefit allowance, or give him a lower allowable death benefit and still qualify as life insurance, which would cut out some expense.
Right. But his wife's policy would have been totally fine.
Yes. And, I'm not saying it would have worked.
That's the default. I mean, that is the correct policy design if that's someone's stated goal. If their stated goal is, I want to use this, 30 years from now, 25 years from now, as a supplemental retirement income source, then the correct design is going to squeeze the death benefit down to the lowest possible level, given the premium that's being paid.
Mm-hmm.
That's appropriate.
Yep. Yeah.
And that was not done here. And the only conclusion one can reach is, well, if I do that, I'm not going to make as much commission.
Well, if we look at the reporting from again, Bobby Samuelson, the commissions on this case tripled by virtue of doing it the way that the agent did it versus doing it the way the agent should have done it.
It was more than that, wasn't it?
We're talking 550,000 versus 1.5 million.
Yeah.
So,
that's a lot.
And that actually the commissionable target here with Pac Life, $1.5 million for somebody who would have been early 30s at the time. That's actually quite high relative to other products in the industry. So, that's already pretty good. I don't know why it needs to be that much better.
Right.
It's always been mind-boggling to me how much some people think they need to squeeze out of every single case.
Right.
And when you try to do that, you end up in situations like this.
Yeah.
But ultimately,
or just end up with unhappy clients in general because they're not getting what they thought they were getting.
No, correct. Ultimately, index universal life insurance works.
Yep.
I think there's probably a case that
sadly it never makes the news for anything good.
Right. Could have been. You could make the case in this situation. Ideally, I think if I got to sit in the chair of what should we, Kyle and Samantha Busch do, probably she's the insured alone because there's no flat extra to contend with.
Right.
That would be the way to really
at least optimize. If you're going after the quote unquote tax-free retirement.
Yeah. Look, if he needs death benefit, we figure out how we do death benefit. That's fine. But I don't think
we could probably do it for a lot less than $1 million.
Yeah, exactly. Exactly. So that's how it should have come together if we were really going to uphold the idea that we're doing this for the accumulation of a tax benefited, tax-free retirement plan, and we're trying to do the best thing possible. Like if we're going to sit here and say we're experts at this and we know how to get you the best bang for the buck, that would be the additional pivot beyond just proper policy design.
I can say firmly that that would have been the first place we would have looked had it been you and I in this situation. Mm-hmm. I'm not saying it would have necessarily worked out that way, but that would have been our first inclination. Let's explore that.
Well, from experience, there have been times that we have had a couple, husband and wife, looking at permanent policies. One is a better insurance risk than the other. They just are.
Correct.
For whatever reason, they decide, no, we want to split it evenly between the two of us, even though it's going to be more expensive for one versus the other. Like that's the decision that we're going to make. And as long as you make that decision, I don't hide it from you.
Right.
Fine.
Right. If your eyes are wide open and that's your decision, then that's your decision. But yeah. Agreed.
So.
Oh, greed. Greed being the operative word here.
Yes. Let's end it on that one. Let's find something else to say. IUL works. Pac Life's weird, but a lot of the idiosyncrasies of Pac Life are not what caused the problem here. It's just bad implementation.
Yeah, it is. And we've seen a lot of bad implementation. I don't know that we've seen one to this scale, but we've cut off some bad implementation before it got really bad.
Yeah.
Yep. We've seen some things that we told people, you realize this is what's happening, and sort of point out where this is headed. There's a trend developing here. And we've been able to get some people out of some potentially bad situations.
Yeah. Yep.
So if you think you might be in a bad situation,
reach out to us. We'll talk to you.
We'd love to.
Don't be like the Bushes. Because sadly, despite the fact that we were around for a long time before they bought their policies, they never called us.
I don't think we have any deep ties to NASCAR, do
we? We don't. We don't. Okay.
All right.
With that, I am Brandon Roberts.
And I am Brantley Whitley.
We will see you next week.